Hello folks, Tom here. We're going to try and very quickly go through a very complicated bit of tax and tax planning, which is, am I better off as a sole trader or as a limited company when I do my trade? We're going to make a few assumptions. So the assumptions are the trade doesn't change. It's just the engine with which you trade through it. So do I go as a sole trader or as a limited company? And then we're going to talk about how dividends are voted, how you get paid out from the company, go over all of that. Hopefully keep it nice and simple. But again, this is my day to day. This is my language. So there are no stupid questions. If you ask me to understand how to break down a boiler and make it fixed and make it work, I wouldn't have a clue. So don't worry about it. Big differences between a sole trader and limited company. So the sole trader, that's you. You are taxed on the profits when they are generated, not on how much money you draw out. So if you imagine you make profit of 50K, but you've got only taken out 20 grand out your bank account and you've left 30 over, the revenue does not care about that. They care about the 50 grand of profit you've made. And that is what you pay tax on. Now, for a company, it's separate. It's a separate legal entity. If you're sat at the dinner table, you imagine your limited company is sat there. It's got its own legal rights, its responsibilities. The company is separate to you. So you own the company as a 100% shareholder or 50-50 with your spouse or however you've got it set up, but you do not trade. The company trades. The company pays tax on the profits that the company generates. And then from that, we work out how you as a shareholder and or a director get paid from those profits. And that's a really key point to remember. The company is not you. The company is a separate legal entity, but you own that company. So working example, we're going to assume this is no different in the actual trade that's being done. It's just whether you're a sole trader or a company. Sales of 100 grand, expenses of 50. But the big difference you'll notice here is that we've got director salary going through here. And the reason for that is that's generally the most tax efficient way of paying out money to the shareholder director of a company is through a salary of 12,570, which is the personal allowance, and then the rest in dividends. Basic standard planning, really. Now that main benefit of that is it reduces the corporation tax bill because you'll see the profit for the company's gone down and the corporation tax is a benefit. And then the director doesn't pay tax on the first 12,570 of income anyway. So effectively tax relief at 19% for the company and tax free for the director to receive it. So great. So you can see down here, when we're looking at the individual's income, the sole trader is taxed on the 50 grand. And then the individual for the company is taxed on the salary of 12,570 and then the dividends of 33,180. So for this example, we're assuming every penny that's available to the director they're taking out on the shareholders. So how is this all taxed? Well, as we've discussed in other videos, we've got the bands, you've got basic, high, and additional. Now the first 12,570 for both the sole trader scenario and the company scenario is tax-free, zero. But then the sole trader pays tax at 20% on the next 37,430, and they have to pay class 4 national insurance at 6%, which is 2,246. So overall, under the sole trader example, the individual has paid 9,732 in tax. In the company scenario, the individual is only paying 2,609. But if you remember in the previous one, there was company corporation tax there of 7,112. So overall, the total company tax and personal tax paid in the company situation is 9,721, and then compared to the sole trader is 9,732. Not a huge difference. However, there are a lot of benefits of being a limited company. You've got limited liability. You can take advantage of trivial benefits. You can have mobile phones paid for out of the company if it's allowable. You've got loads more tax planning opportunities. With a sole trader, you're just taxed on the profits when they happen. There's not a huge amount you can do about it. So I always favor limited companies purely because back in the day, it used to be a massive tax benefit of doing it, but also it's that limited liability. If things go wrong, the company goes down and not you. So that's an important thing to note. So next up, if the profits were 80K, look at the difference. Slightly different now. You'd think it'd go the other way, but actually the company situation does end up paying a little bit more. And that's because the first 50K of profits of a company is taxed at 19%. But then you've got marginal rate after that. So effectively from the 50 to the 250, anything in there is taxed at 26.5%, which is quite a chunk. But I won't go into too much detail. That is how the tax system works. But what we need to know now is how do you as a shareholder director get money out of your company? So your company generates the trade. We've then got to get money out to us as individuals because we need to live. So the first bit of that is the director's rem. the remuneration. Effectively, for most business owners, it's going to be 12,570. Nice and straightforward. Next up is calculating the dividends. So in this example, what we're saying is that, husband and wife, they own the company, they go out, do the work, company makes the profits. How do they get the money out? Both get a salary of 12,570, and then they're left with the retained earnings of the company. That sits on the balance sheet. So that is the profit brought forward, less any dividends, plus the profit of the current year. That is the retained earnings. And that is what's distributable to the shareholders if cash flow allows. So important things to note here: dividends are not a God-given right. All right. You can only receive dividends if the company has generated enough profits after tax that they can be voted. There is a lot of paperwork involved. You've got to ensure that when dividends are voted, the directors vote to pay those dividends. And then when the shareholders receive the dividends, they receive a voucher from the company to say, we have paid out a dividend of X, Y, and Z. And that is covered on this page here. So jump the gun here. I thought I'd put in a nice shiny car because this is probably the most boring video you'll watch for a long time. But don't forget, minutes. The directors sit down at a table and they say, right, we can see that the company has got retained earnings of 80,000 and we are therefore going to vote dividends of 60,000 to the shareholders. They also need to demonstrate that the dividends will not make the company insolvent. And what I mean by that is, although you might have 80 grand on the balance sheet as distributable because you've made good profits, what you might not consider is that those profits have been generated because you've got a massive loan book. You've had to borrow loads of money and use that money to purchase equipment. So that capital cost each year that's coming out doesn't go through the profit and loss. It comes out of your cash. So you could have a profitable business but no cash. And if you then vote dividends that gets paid to the shareholders but leaves the company insolvent and unable to pay its debts as they fall due, then both Companies House, HMRC, and the creditors are going to have something to say about it. So watch my other video about the difference between profit and cash flow, but that's a really key point. You can only vote the dividends and pay them out if the cash flow allows it. There's no point voting dividends if it's going to make your company go bang. So interim or final, these are the two types of dividends. The interim ones are done through the financial year. So if you imagine your year end is November, you'd be doing them, staggered through the year, monthly, quarterly. I tend to say to clients, do it after your most recent VAT return. So you do the VAT to the end of November, and then you look at it and you say, well, what profit did the company make in that period? What has brought forward? What dividends have been voted? This is what's available. How much do we need to pay out? What is the most tax efficient amount? And then you do the paperwork that says we've voted these dividends. Nice and easy. And then the final one, you get to the end of the year and you vote it. It's not a God-given right. It's only if the company, the directors decide if the shares deserve a return on their investment effectively. The company can decide not to vote any dividends. It can build up the cash balance and the reserve balance for years. It makes no difference. So, scary thing to talk about is the director's loan. And I appreciate I'm going through this quickly, but I don't want to be death by PowerPoint for this slide. So you imagine you're a shareholder director and you take your 12.5 salary and then you've got 30k dividends each year. But unfortunately, the company's had a rough year. It's only made 20 grand's worth of profit after tax. So you've overdrawn by 10 grand. And that's all that means is you've basically drawn out more than you should have received. And that creates an overdrawn DLA. And the important things to note here are there are some problems with this. So first off is Section 455 tax. So effectively, this is what I call a holding tax. It's as if the company has loaned you the money and the revenue want you to pay this S455 tax, which is 33.75% of the balance at the accounting period end. That is payable 9 months and 1 day after that year end if the loan is not repaid within 9 months. So it's a really important thing to do here is to keep on top of your accounting records, because if you drop your stuff off to me 1 month before that filing deadline and I can't clear that director's loan account previously, we've got a problem. You've got to pay that S45 back. And if you do pay it, it can take years before you get it repaid because you've got to make sure it's repaid and the timing periods is quite difficult. Anyway, that's a long story. You guys are not chartered accountants. You don't need to be going into loads of detail. But next up, benefit in kind. Any loan to a participator, so that's a director or their spouse or a family member or anyone related to the company, must have interest charged on that loan at the commercial rate. And the commercial rate dictated by HMRC is known as the ORI, which is the official rate of interest. It's available on the HMRC website. If interest is not charged at that or above, the company has to do a benefit in kind declaration. So it's saying we have loaned money at below market rate. The company pays national insurance. The person that's had the loan pays tax on that BIC. It's not great. Illegal dividends, I'll just touch on that. So effectively, this is where if the company hasn't generated enough profits, so let's say the company made profits of 50K, but the directors voted dividends of 80, it's an illegal dividend. You've not had enough reserves to vote those dividends. So the revenue could quite easily scrap those dividends and say, actually, we're going to treat this as salary, hammer you with tax, hammer you with national insurance, employers' national insurance kicks in. It is a nightmare. Oh, and this is where my slide is my template is not updated, so I need to update that. But effectively, we'll go back to here. So look, I know this is a lot to take in, but the important thing to remember is you almost need to have a plan every year. And I do my plan with clients in February each year where we say, this is the current tax rules. How much do you need to live on? This is how much the company needs to generate in profits for you to live on that income. This is what it'd be in salary, and this is what it is in dividends. And it's as simple as that. And you stick to that through the year. We do the paperwork quarterly for the dividends, or we vote them in one lump sum, and then we make sure we're still on top of it, because it's important to remember dividends are voted in advance of the payment. You can't do them retrospectively. So I hope this has helped. If you've got any questions, which I'm sure you will, give me a shout. If not, speak to you soon. Bye-bye.